Welcome back. Welcome to a big week of economic data, headlined by July's CPI report, the big inflation report on Wednesday. Our next guest believes the Fed should not and will not raise interest rates at all in 2026. Let's bring in Mark Zandi, chief economist at Moody's Analytics. Market now coming around to that idea too, Mark. Why do you think, with inflation still running above target for many years now, the Fed should do nothing?
Well, Sarah, I think inflation has peaked. I mean, I'm assuming the Iran war is not going to go off the rails here, that oil stays somewhere around $85. If that's the case, then I think we'll start to see inflation start to come back in. A lot of the inflation is related to policy. It's related to the tariffs. It's related to immigration policy, and it's related to the Iran war. And as those effects fade, and they are fading, I think inflation will come in. And the other thing that's really, I think, critical is inflation expectations. I know there's lots of different ways of measuring it, but if you look into the bond market, which I think is the cleanest read on expectations, they remain very well anchored, very consistent with where you want them to be. So, given that, I think inflation is going to come in. And perhaps as important, if not more important, as you know, I'm pretty nervous about what's going on in the labor market, the job market. It's very weak. We saw that the data we got last Friday. Most significantly, wage growth is coming in pretty significantly. It's now below the rate of inflation, so real wages are falling. So, you add that all up, that to me argues for the Fed should not raise rates. And historically, my thinking about what the Fed should do and will do is about the same, and I think that'll close call, but I think that'll be the case here.
I kind of thought that they should have raised last meeting because Warsh was talking so tough on inflation and really wanted to make it clear that this is a new paradigm where we do not tolerate inflation. He's always said inflation is a choice, so to back up the words with some actions. But I don't know, you think he'll get away with this strategy if he doesn't need to do that, where just financial conditions do the work?
Well, I think it depends on the data that we're getting. I mean, the job market data was really pretty tough, pretty bad. So that's consistent with his view.
Yeah, but some people think, look, the World Cup give back, leisure and hospitality was a big negative drag on that one, that there were some temporary factors in there. Unemployment rate still at 4.1%. They're not, I think Atlanta Fed GDP for third quarter is tracking like above 5% growth.
Yeah, well, it always does early in the quarter. I mean, GDP growth is 2%. That's what it was last year. That's what it was first half of this year. That's what it feels like it's going to be this quarter going into next. But jobs is what really matters, and what really matters is wage growth, and that goes to inflation too, right? I mean, at the end of the day, the most significant driving force behind inflation is the cost of labor, unit labor costs, and unit labor costs are going nowhere because wage growth is decelerating. So he's right about that. If in fact that's what he was trying to say at the meeting, I mean, I don't really know what he was trying to say, because it was, obviously his efforts not to provide much transparency around how he's thinking about things. So I don't really have a clear view as to what he's thinking. But if his view was, I don't need to raise rates, I think the job market was certainly in his camp. And we're going to get that inflation number on Wednesday for CPI, PPI on Thursday. So we'll get a better read on that. But I think they'll be friendly to that view as well.
Mark, how do you think about just the dominance of the business spending, the CapEx theme running through the economy, whether it's the GDP numbers, whether what it does to some commodity prices, and whether, in fact, you have to therefore make some call as to whether it's going to create a big productivity boost down the road?
Well, I think it's great. I mean, it's a key source of growth, but it's not as much a boost to growth as one might think, because a lot of that CapEx, capital investment, is imported stuff, right? I mean, all the stuff that's going into these data centers is imported from Taiwan. I just saw a recent statistic. Mexico is shipping more servers, value of servers to the U.S. than they are autos. That's just incredible. So it's driving a lot of growth. So the net of all of that, it's great. It's good, but it's not going to get us above 2% growth, and it's not going to create boatload of jobs. But it's great because longer run, as you look down the road here, it should help to support increased productivity growth. I haven't seen it yet, but it does feel like that's coming.